And let me welcome you all on the persistent call, the first one in 2018. And I'm really delighted to share with you the financial results for the third quarter that ended on December 31st. The highlights of the financial numbers are that the revenue during the quarter Q3FY18 in US dollar terms were $122.53 million, which is about 3.8% quarter-on-quarter growth and a yearly growth of 11.4%. The revenue during this quarter was 7,918.90 million rupees, which was a 4% quarter-on-quarter growth. The profit after tax during this quarter was 916.70 million rupees, which constitutes a 10.9% quarter-on-quarter growth. As we have completed 3 quarters of this financial year, I would like to state that the revenue during the 3 quarters of this financial year totals $353.60 million, which is a 10.5% year-on-year growth in dollar terms. The same amount in rupees is 22,811.57 million rupees, a growth of 6% year-on-year. The profit during this period has been 2,493.82 million rupees, which is a 9.1% year-on-year growth over the 3-quarter period. I'm also delighted to share that the Board of Directors at its meeting declared an interim dividend of rupees 7 per share of a face value of 10 rupee per share for this financial year. I'm also delighted to share that the board has decided to induct Mr. Sunil Sapre, our Chief Financial Officer, as an additional director on the board, and henceforth his designation would be Executive Director and Chief Financial Officer with effect from Jan 27, 2018. With these very high-level overview of the numbers, I'm going to invite Sudhir Kulkarni, who is visiting us from the US and is currently at the airport, to share a little bit about the digital business and what he saw in the US side. I'm going to also invite, after that, Sunil Sapre to share the details of the financial performance, specifically around the various accounting terms and activities that have happened. And after that, I will take over again and share a little bit about some of the sales wins and some of the deal wins and other things and other points of interest that may be followed through. And then we will open it up for questions very soon after that. Thank you, and let me invite Sudhir Kulkarni to share his point of view.
Thanks, Anand. I hope you can hear me. This was a quarter in which I think we consolidated our focus. We've been talking about co-creating models, or co-creation models of digital solutions, especially in the areas of healthcare and financial services. This is important as one looks at the significant changes that are happening in the U.S. healthcare industry, for example, for the long term. I would characterize the big changes as almost a tectonic shift taking place in healthcare. For example, the acquisition of healthcare insurance company Aetna by CVS, which was a $69 billion acquisition. So CVS is a pharmaceutical distributor, or the acquisition of a $41 billion Hospital Corporation of America by an insurance company, UHG. These are all sort of massive changes that are happening. So all of these indicate to me that the lines of distinction between payer, provider, and pharma and distributors, which were pretty clearly drawn in the past, are almost becoming like lines in the sand as the world of healthcare realigns. Now, on a micro level, all that a patient, which is a consumer of healthcare, cares about is getting the best healthcare at the lowest cost. And there too, the focus is shifting at a micro level, if you will, from curative to preventive care, from episodic to wellness monitoring, from in-room consultation to remote consultation and monitoring, etc., from in-person treatments to robotic surgeries and so on. So I can go on and on, but you get the point that there is a very different kind of a model that leverages state-of-the-art technology and in patient care, in operations, hospital operations, as well as creating new models of care. Now, that's where we play very significantly with our long-term bets. And in this context, I'm pleased that our work with Partners Healthcare and a few other hospital systems in building digital platforms and clinical and operational applications is progressing well. And I had previously called it our co-creation models, where we take risks along with our customers on their digital transformation journey. Now remember, these are long-term bets, and our investments will yield results over the long term. So suffice it to say that in the short term, these will not show major movements of top line, etc. But we continue to invest in these because we believe in them, and these digital models are the ones for the long haul that will transform the healthcare industry, for example. Obviously, at our size, we could only take some of these bets, and we decided to take those in the transformation of two major segments in the industry: healthcare, with mainly care management in providers, and financial services, mainly adoption of new technology from fintech into the digital banking space. Now, the unit as a whole, the digital operating unit as a whole, grew to about 26.81%, which was a 3.9% growth organic, and including Fox, the acquisition, it was about 9% Q1Q. We've maintained a 45% year-to-date growth over the last three quarters, if I look at the three-quarter summation. And this quarter, we added several new enterprise customers and grew some existing digital programs at large existing customers. Some of the major new ones include a healthcare payer, a large hospital system in the Midwest, a bank, an exchange, and a large retailer. We had decent traction in the DACH region, where we did the Fox acquisition, and in Australia, where though our base is small, we are seeing some nice growth coming from that geography. And I expect that with some renewed focus on specific countries within these geographies, we will build some momentum over time. Now, our investment in digital IP or IP assets, including frameworks and accelerators, while not generating large license revenues yet, have begun to give us some leverage in building solutions and services around them. And one more thing, even as our focus continues on building innovative solutions and co-creation models, over the last couple of quarters, we also saw a small uptick in terms of margins in the digital business. And obviously, we are going to keep consciously building this business for the long term. We are going to keep investing in this, but this uptick is nice to see this quarter as well. So with that, I'm going to hand over back to Anand for continuing the rest of the call.
Let me now invite Sunil to share the details on the financials, please.
Yeah. Thank you, Anand, and good evening to all of you. And let me wish you a very happy new year to all of you, being the first call in 2018. I am indeed thankful to Anand and the board for my induction as a board member. As you have already heard about some of the updates Anand gave and Sudhir mentioned about some flavor of the digital business, I will give you an update on the margin movement, the capex and liquidity position of the company. The revenue for the quarter was $122.53 million, recording a growth of 3.8% quarter on quarter. The growth was comprised of growth of 2.7% in the services revenue and IP-led revenue, which grew by 6.8%, being a seasonally strong quarter for the alliance business. In YOY terms, the growth was 11.4% for this quarter. Revenue in rupee terms was rupees 7919 million, with a growth of 4% quarter on quarter and 6.2% year on year, essentially due to the currency movement that happened during the year. For the 9 months, revenue was $353.60 million, with a YOY growth of 10.5%. On more details about the revenue, the linear revenue, which we saw grew by 2.7% quarter on quarter, was mainly due to the increase in billing rate. The on-site linear revenue grew by 4.7%, driven by volume growth of 2.9% and growth in billing rate by 1.8%. And the offshore linear revenue grew by 1.1%, primarily due to increase in billing rate by 1.7%, while volume dipped by 0.6%. On the EBITDA margins, the EBITDA margin improved to 17.4% this quarter as against 15.2% in the previous quarter. As you know, we had a wage hike during this quarter for the junior level staff, and this was primarily offset by improved utilization and other operational efficiencies. The utilization for the quarter was one of the highest in recent quarters at 79.9% as against 78.6% in the previous quarter. You will find some movement in G&A expense, which is mainly because in the previous quarter, we had a credit of rupees 41 million on account of insurance claim settlement, whereas in this quarter, there were professional fees relating to parks acquisition and certain other tax and advisory services, which amounted to rupees 35 million. The growth in EBITDA was 10.9% quarter-on-quarter and 4.5% year-on-year. In terms of depreciation and amortization, it came in at 5%, same as in the previous quarter, and EBIT was 12.4% as against 10.2% in the preceding quarter. So far as other income is concerned, it came in higher at 143 million rupees as against 133 million rupees in the previous quarter. As regards Forex, due to rupee appreciation of 2.2% during the quarter, foreign exchange gain was lower at rupees 50 million as against rupees 203 million in the previous quarter. You would observe that in the previous quarter, rupee had depreciated significantly to 65.33 at quarter end, whereas in Q3, rupee appreciated in two stages. First, from a level of 65.33 to about 64.50, and then it closed at 63.87 as on 31st December. And this is the main reason for the swing in foreign exchange gain. In absolute terms, PBT was rupees 1175 million at a margin of 14.8% as against 14.6% in the previous quarter. The tax provision came in lower due to reversal of tax liability in certain overseas jurisdictions on completion of assessments and tax benefits for R&D related work. As a result, the ETR was lower at 22% for the quarter as against 25.9% in the previous quarter. So the final result on the PAT for the quarter was rupees 917 million at 11.6% as against 10.9% in the previous quarter. The growth in PAT was 10.9% and quarter-on-quarter and 11.9% year-on-year. For the 9-month period, PAT was rupees 2494 million at 10.9% of revenue, registering growth of 9.1% over the same period last year. The operational capex for the quarter was rupees 19 million. Cash and current investments amounted to rupees 1117 million as on 31st December as compared to 9992 million as on 30th September. The value of forward contracts outstanding at the end of the quarter was 85 million with an average forward rate of 67.10 per dollar. Thank you all, and I hand it back to Anand.
Thank you, Sunil. I'm going to give you just a few things to add before we get into the Q&A side. I'm also delighted to share that for the first time in the history of the company, we have more than $1 billion of cash and $1 billion rupees of cash in the system, which is an achievement for us. And the other thing I wanted to point out was that we have added Mike Kuklenko, who joined us as Senior Vice President for Sales. He's based out of UK and will be driving our business growth in Europe. Some of you, Mike used to be part of IBM, and he was involved in working with us very closely on the CECLM products, where he was running the sales team for the IBM CECLM product team. We are delighted to have him join us on our team as we significantly strengthen our reseller business and go direct to customers in the CECLM portfolio. We are very confident that with him joining the portfolio, it strengthens our positioning in the market as we go direct into this market as a reseller. A couple of other wins which were already mentioned by Sudhir, but in addition to that, we had a good opportunity of building out some next generation solutions that leverage cognitive and artificial intelligence and machine learning in terms of building product solutions for some of our large customers. And these will help us in the long term as we look at our growth. I would also like to invite all of you to take a look at our website, where we have some very interesting videos about some of the work we have done, including a very nice video with Pune Police about the Dial 100 emergency response services that we have put up. We also announced the launch of the Accelerate Share Insight 2.0 product, which is a really nice self-service big data analytics platform, and we hope that generates revenues for us in the data and analytics space that we are looking at for next year. I'm going to take a pause here, and I'm sure you have many questions. I will request the host to open up the lines for you to ask questions, and we will answer your questions for the next 45 minutes. Thank you very much.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sandeep Agarwal from Edelweiss. Please go ahead.
Yeah, hi. Thanks for taking my question, and Happy New Year to Anand, and congrats to Sunil. So I have two questions. Just wanted to get some qualitative input on that. So Anand, if you see, since last year our ISV business contribution has gone down by 5%. Still, our 9-month YTD growth is like 10.5%. So does it clearly mean that the bottom of the growth for us is definitely behind, and we can see a very significant jump in growth going forward? So that is question number 1. And question number 2, which is not related, but I would like to understand that we have not been able to do much on the other than US market in terms of revenue. The contributions have definitely moved up by 180, 200 basis points in last 9 months, but why are we not going very aggressive in the European geography, where we are hearing a lot of deals are coming in, particularly digital arena? Or you think that US itself is a very, very huge market and there is enough food for us in the US market alone?
I think two very good questions, Sandeep. On the first part, when you mentioned the ISV stuff, actually I also believe in the ISV market. I think that's a market that has been good for us for the last 27 years. So we definitely want to continue to invest in that market, and we do see good signs in terms of business coming in that area. So I hope we will see continued growth on that area. That said, I think our overall strategy at the moment is to stay focused on providing businesses to become software-driven businesses. So we are continuing to focus on the broader market in terms of helping companies to become software-driven. So the observation that yes, we are starting to see the bottom on many of our legacy business is actually true, and we are definitely continuing to increase our growth in that market, and hopefully you will see in terms of absolute numbers growth happening. But when you compare that in terms of percentages, I don't want to comment a whole lot, because it all depends on what other businesses do, which we hope also grow at a rapid or equally rapid pace. Now, regarding your second question regarding Europe, again, your observation is very right. And two things that you should note in that context is, one is, of course, we just announced the Sparks acquisition about 5 months back, and that has started to just come online. We wanted to make sure that we got a consolidation on some of the basic stuff there, and you will see an increased focus on European business. Also, Mike Kuklenko joining in Europe at the level of seniority that he brings in should help us in getting some more activities to happen in Europe. We have a plan on how to increase our reseller business on the CECLM part, which has a very significant European presence, and you should see some more activity on Europe. So definitely looking at non-US geographies is clearly the objective, and if you look at these numbers 12 months from now, I think they will look very different from what they are today. But when you're sort of looking at percentages, it's very hard to make a dramatic shift in the numbers as percentages, but you will see a steady increase for sure. Now, on the quarter-on-quarter basis, you might observe that there was a dip on the European business, but I want to reassure you it is because of one specific Accelerate deal that we had in the last quarter, meaning the previous quarter, which did not happen this quarter, which is why you might seem like it was a dip. But overall, The European business continues to be a stable growth business, again, much smaller than US for us, but definitely growing. I just want to stop here on this question, but we'll take the next question. But before we take the next question, I just wanted to let people know that we are tracking on Twitter, and if you have a question, you should send a tweet on #persistentresults, and we will pick those questions up after every few questions, depending on what comes up there. So that could be another channel for you to reach us in terms of if you have a question as well. Let me now hand it back to Aman.
Yeah. Thank you. The next question is on the line of Nitin Jain from Credit Suisse. Please go ahead.
Yeah, hi. Thanks for taking my question. So I have two questions. So first on the margins. So how much of the expansion in margins in 3Q came from the IP business, which will eventually reverse in 4Q? And how much of it was from efficiencies and high utilization?
So as you can see in terms of the utilization numbers, the increase in utilization was 1.3%, and the increase in IP business essentially was of the order of about 3 million. So overall increase in this EBITDA percentage is contributed equally by both the parameters.
Okay, so half of that is sustainable, you mean to say?
Yeah, it also depends on, when we are moving into the fourth quarter, the operational efficiencies, of course, need to hold. And so far as the business is concerned, the substitution of business with the seasonality of IBM business, if it happens through the IP route, then it has a possibility to hold. If you have, the substitution of business happening from the services business, it has an associated cost. So that's the only way to look at it.
Okay, thank you. And the second question is for Sudhir on digital. So are you satisfied with this 30 to 35% organic YY growth in this digital business? Given your smaller base, can this business grow at a faster rate?
I mean, nobody can be satisfied with whatever they have, right? I mean, we are as I said, consciously putting some efforts in there in terms of the programs that we're launching with some customers. Now, some of these are producing results in short term. Some of these will produce results in the long term. So I don't want to just say that, I mean, we can go for bigger, better growth. We certainly can. We are putting a lot of effort in certain specific areas. But I don't want to just, hold out a thing out there saying that we can grow multiple times that what we have. I mean, certainly we are making all the effort that we can.
Okay. Thank you.
Thank you. The next question is on the line of Apurva Prasad from HDFC Securities. Please go ahead.
Hi, thanks for taking my question. Anand, a couple of quick ones. I think you mentioned earlier, but if you can probably highlight about the Accelerite part of our business, the steep decline this quarter, and what's the outlook on that piece? And my second one is on the margin. So, Sunil, if you can help me with the wage impact on that.
Let me have Sunil answer that question quickly, first one, and then I'll give you the answer on the Accelerite side.
Yeah. So on the wage hike, we effected the wage hike for the junior staff, and the impact was about 85 basis points.
Okay.
So let me comment a bit on what's happening on the Accelerite side. Okay. So as you would be aware, one of our premise on Accelerite was to take on end of life and potentially declining product lines. So we sunsetted two products, one around the location side and the other one around the R Cloud side. Both of them generated the revenues that we thought we could generate, and they were overall a fairly profitable business for us. We haven't done any more Accelerite acquisitions in the last couple of years, and that's just because we haven't found the right ones as such, and we ended up doing some of those as part of the alliance business in some form or the other, where we had a similar effort required in terms of rebadging employees and all the other work that we did, which could have been part of an Accelerite business, but that actually ended up as part of the alliance business. So we have continued to be on this lookout for acquiring assets and acquiring teams and all of those things. So that part of the business continues to be there. The last 2 years, we have tried to, more than last 1 year, we have tried to also make sure that the assets and the customer base that we have on Accelerate can be used for launching new sets of products. So we have 3 lines of products that we are, which are completely based on the Accelerate portfolio, and then Share Insights. So the 3 lines of products that we are selling as part of the Accelerate line, one of them is related to cloud and cloud-related stuff. We have rebranded that as Rovius. That is starting to hit some traction, but we should see more action on it in the next 12 months. The second one was the endpoint client management product that we had, Radia. We are continuing to support Radia and maintain Radia, but the growth on that part is going to come out of Sentient, which is our which is the next generation product, which will allow you to do real-time monitoring, and it becomes very relevant in the security context, especially when you look at the kinds of challenges where machines get infected and trying to disable machines and getting them going is becoming a big issue. So we are very confident that Sentient as a product will do well in that market. And the third line of business that we are focusing on is around the IoT and concert stuff. So we have taken the assets that we have acquired from Epona and trying to extend those to the IoT market. So that's really our strategy for doing what we are doing in that area. And then we have a new product that we have built around Share Insights. So, as I have pointed out to you in the past, in general, we are on a journey to migrate our business, which has been purely effort-based for ISVs, which is the traditional business, which was the OPD business that Persistent did well in, to a model where we have IP-driven revenues, which are value-based, and going to customers that are broader than just ISVs, so that we can provide them help on their journey to become a software-driven business. And this is the journey that we are on. So, while we want to share with you all the details, I think one has to look at a rather holistic view of the company, and some of the Accelerate IP will be sold as IP, but it comes with IP packaged with a bunch of services that are being counted as part of the services and other business. And all of these are helping us transform us from being a effort-based company to being a value-based company. And this is going to be a journey that's going to be our path for the next few years.
That's helpful. Thanks and all the best.
Thank you. The next question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi. Thanks for taking my question and wish you a very happy new year. So this quarter, specifically from an Accelerate perspective, I think we have seen margins come off quite sharply. Any specific reason for that, and is that a one-off, and do you see that coming back?
No, the margins have dropped predominantly because the revenue has dropped. Okay, so it's a small base on which which a fixed cost of engineering, and that's the reason why that has happened. And the part of the revenues that dropped were also because few deals. There were 2 things actually worth pointing out here. One particular thing is regarding a trend that we are going to see in these kinds of businesses as we look at newer businesses, that there was a particular deal that we have done, which is a reasonable sized deal, which would have helped in making the margins happen. But instead of selling that as a one-off license deal, we were able to convert that to a revenue share agreement over a period of time. So it's a 5-year deal now instead of a 1-year deal. And we believe that that's really what people are looking for. They want SaaS revenues, operational expenses, rather than just IP shot, one-shot, single-shot license deals. And we will see some of that, and those will give better returns and long-term stability in the business. So we had one of that happen. And the second reason why there were a couple of other deals that should have closed, but we didn't want to discount this quarter, and we hope we will get them better. We did not, I did not let Nara say just discount to get it this quarter. We will get it next quarter, I think, is what I'm looking at.
Sure.
So the margins will come up for the numbers on Accelerate for sure. Once the revenue goes up, it automatically hits the bottom line because the cost is fixed.
Sure. And just one last one on digital. Digital during this quarter, if I exclude Parks, it appears to be quite weak. So again, is this just a quarter-specific thing, or there's enough in the pipeline to bring it back to normal growth that we've seen in the past?
Yes, Sudhir is there. I'll let him answer.
Sure. So yes, I think we were expecting a few things to close this quarter, the last quarter that didn't happen, and I think the pipeline is fairly good. We should see growth in the business, and obviously Parks has added a little bit of a bump there. But yeah, I mean we will continue to execute on the path that we set out. It is something that is a weak quarter, I would say. I was quite clear that we would have probably done a little bit better than what we did.
Sure, fair enough. Thank you so much and all the best.
Thank you. The next question is from the line of Mohit Jain from Anand Rathi. Please go ahead.
Hi, sir. 3 questions. One is on the volume growth for the quarter. Like we saw there was a marginal decline if you remove the park numbers on a QOQ basis. The last few years we have seen some growth in linear business as well in the third quarter. So any specific reason or client ramp down that you would have noticed this quarter?
No, I think, one of the things I would point out is that, and I had mentioned this in the last couple of quarters as well. See, overall, I'm starting to see good traction and good quality business for us. So we are saying no to bad quality business. Okay. Now, this is not going to see a dramatic down, but I'm not chasing bad business anymore. I was last year, but not anymore this year. We have stopped just doing staffing projects. So this will have some impact on the linear business, but I think overall quality of business, improvement of quality of business is very crucial right now, and that's really the plan. So that's what I would say is the reason why you would see a slight negative on the services business.
So saying no also means closure of certain projects, or you are not taking new assignments?
No, it's not like we shut down any accounts, but we did not follow through on some of the accounts where people were expecting staff. See, one of the things that, starting to happen, and it's a trend that we are trying to avoid is, see, the captives in India are starting to ask for a lot of headcount resources staffed in their offices. So we had some business in that category, but we have now sort of consciously started to turn ourselves away from those kinds of businesses. So you'll see some of that happening. But again, we will manage this as it comes along.
Okay. Second is on parks. Like when will it start contributing to your margins? Like next year, next quarter?
No, I think you'll start to see improvements on margins already, and you'll start to see that it's generating profits on margins from next quarter, next financial year. I mean, next quarter onwards, you'll start to see some numbers, and again from first quarter of the year. I think it's a good asset. They are doing quite well, and I think there are opportunities of extending the work that they are doing in DACH region with fulfillment from our Indian team. So that's sort of where the improvement on margin is going to happen.
But they remain profitable.
Yeah. I mean, it's not as profitable as the rest of our business, but I'm sure we'll get there pretty soon.
Okay. And lastly, sir, for Sunil, sir, any outlook on margins for next year and tax rate?
And we don't have an answer to your question, right?
Tax rate?
Tax rate, he'll give you some idea, but we don't know what Trump is going to do. And we have the budget next week, right?
So, I mean, just to answer you, Mohit, as you see, we still have certain levers to improve, areas like on-site utilization, the traction on the IP deals. So these are basically the areas which contribute to margins more than proportionately. So the whole idea will be to concentrate on that and hold the improvement in utilization that we already achieved. So the rest of it will be played by the business mix that we are able to achieve.
You still find some scope for expansion and utilization in it?
Yeah, I think the profit margin improvement will happen by changing the mix of the business. Okay, meaning there is, utilization. Yeah, you can get a few percent point here and there, but it's not going to be dramatically. There is not a whole lot of room in it. On-site, offshore, there is some room, but I think the focus. See, what I can say is that I'm quite pleased at the point where we are in terms of the quality of new deals that we are seeing in the market. The new quality deals actually generate better revenues, better margins, and long-term sustainability with key partnerships where we get a seat on the table. That's really our objective, and we are starting to see more of those. And that's what's going to generate growth, and that's what's going to generate the margin.
So that is more on revenue per employee side that we will see some changes happening.
Yeah, that will give you meaning. Finally, you got to beat this out through revenue, man. Only so much you can squeeze on the costs.
Right. Lastly, on the tax rate, any benefit that you guys, because you have a large business in US.
Yeah, it's all not worked out, Mohit. We'll get back to you on that one in a while. I think next quarter will be in a better position to answer that question. We have, of course, believe that yes, there is a improvement because tax rates are coming down, but it's more complicated than that, unfortunately.
Sure, sir. All the best. Thank you.
Thanks. And we can follow up on this on an email question as well. I want to take a question that we have on Twitter right now from Ankit Pandey saying, what's the update on the IoT business profitability on the IBM IoT stuff that we have, right? So let me give you a quick answer on that. So, for those of you who track all these numbers at the level of granularity that you do, we had a 5% growth this year, and I'm talking calendar year, and we got about $49 million in terms of our revenue. We counted about $15 million this quarter. So that's really the bare bone numbers that I'm giving you. In terms of the profitability for this quarter or this year for the IBM business, the profits were better this year than last year, but they were not still at the level where they are, hugely profitable. But the subsidiary and ancillary business and other things that have happened along those lines have been really good. We have really gotten many other smaller deals which you don't see in this one, but direct relationships with some of the large auto companies and other things have been really the benefit of this. Next year, we hope and we believe that we should have a similar rise in the revenue numbers for the top line, and the fact that we have managed to reduce costs for the next release that we are submitting and proposing should give us improved margins for next year. This particular business on its own, just the part on this, the engineering of this product will be profitable. And next thing also is that we believe with Mike joining the team, we should see more revenues across the board and should generate better margins for us. See, as I said, there is business happening. We were not able to make it partly because we were not reselling directly, reaching the customers. With Mike joining the team, I think we can change that. And he was the one who was running the entire business anyway. So he knows all the customers. He knows exactly what they have bought. And now with him working for us, we should see some growth there. Let me go back to Aman and get going. And I'm going to start to be giving you shorter answers now because we have several people who have questions on the list.
Sure. Thank you. The next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hi, thanks for taking my question. Anand, just a question on where are we in the journey of transitioning from just doing project-related work to more solution-based work, which will be more longer-term in nature and give us more sustainability of revenue as far as digital is concerned. If you could throw some metrics around that, it will be very, very helpful. Thank you.
No, I think absolutely we are on that journey. I think, as I said, with this quarter, I can very confidently say that we believe that our story is working. We have been trying out this in various different formats, but I think we have a pretty good idea on what needs to happen. I do expect that, next year, we should double down on some sales efforts to make sure that we can replicate the wins that we have had across a broader and wider portfolio. So I would say we are on track in terms of the kinds of deals we have closed. Now, as I pointed out, or rather Sudhir pointed out, the focus is on the digital side is a lot more on the healthcare side, where we think there are lots of very interesting opportunities. Some of the work we have done in the financial sector also are around digital opportunities. And then with Mike and others joining on our push on the industrial stuff, also we have done some really good work in the last few quarters, and it should start to show results next year.
Sure, thank you. And second question, do we have any big investment planned for the next year, either with respect to IBM CLM product or with respect to digital, or do you think it's going to be an investment as usual we do in the business?
See, it's very hard to. So let me say the following: we have $175 million on our book, and clearly we are looking for acquisitions of different kinds. We definitely want to make sure that these acquisitions are accretive and also are taking us in the right direction. rather than just adding revenues and volumes. So we will look for IP and other domain-centric acquisitions that help us either distribute or grow in regions outside of North America, or give us access to IP and technology in the newer things. So those two things we are continuously looking for. On the IBM side, again, it all depends on what gets offered, but I'm not trying to acquire a whole amount of legacy business at this moment, because, we really need to get the transition to move faster than it is, and, acquiring legacy would not be the right thing to do at this moment.
Thank you.
Thank you. The next question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Good evening, sir. Thank you for taking my question. My first question was more on the SG&A expenses. I've noticed that year on year it's come down from 14.6% of sales to 12.4% of sales. So how sustainable is this, and what can we expect going ahead?
So, it's again, some of these things are a little bit plus or minus, depends on how the deals get closed. But I do expect that we will invest in sales next year. But I'm also confident that revenue should go up to the extent that the sales numbers would be in line with, the SG&A expense. But, meaning there is no reason for SG&A to go down at this time.
Okay. So, and my next question was, so in this transition from the effort-based business to a more linear kind of a business, I've seen that the services contribution has reduced from 48% to 42% as of Q3FY18. So what is your aim or target mix, if you will, over the next 5 years? What can we expect?
No, 5 years is too long, man. But in the next 2 to 3 years, I do expect that the services business also will transform to being not effort-based, because every time we go to a customer, the customers are also asking us, hey, show me value, don't just show me effort, which aligns with where we want to go. So I think the services business will grow. We'll still continue to be a services-driven company, but I think the effort-based business will, in the next 2 years, I would like to see that in the sub 30% range, where 70% of our business is coming from value that we are providing to customers rather than just effort. And we'll see how it goes after that.
Okay. And so just last, if I could squeeze in one more question. So could you just throw some light on this co-creation model that you've been talking about? Any kind of, is it a revenue share agreement completely, or how?
Right. So let me explain a little bit about how these go, and everyone is unique and different. But what we try to do with the customers are that, so we convince a customer, or they convince us, however, we agree that we should build something that can have long-term value. And the idea is to see if we can get some revenue share out of that, rather than just be billing it out one time on effort. So some of it so now then the issue becomes who spends when, and when do you actually monetize it, and who shares the risks. So depending on the situation and the customer context and our ability to see how aligned it is to various areas, we have been trying to get, in many cases, lower stop on that. So we get at least some money for our costs, and then we are sort of taking a risk on some of the top line in some sense as a percentage of the revenue that we make. So there is a little bit of that happening across the board. But, we have to manage this within range is what our goal is. So we are not doing this unconstrained, but I think these things will give you long-term returns and long-term margins in some sense. But I think it's important that we do some of this, because this whole linear effort-based business is, set for it has a, expiry date in some sense. You can't continue with this forever.
Correct. Thank you so much. That answers my question.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to one per participant. Thank you. We have the next question from the line of Nirav Dalal from Maybank. Please go ahead.
Thank you for the opportunity. I just had a question on the IBM IoT deal. You just said that you did 5% growth this year. Are you happy with the growth, and what what number would it have been if not for that?
No, I think 5 to 7% in this kind of a market for a stable product with IBM selling it. I think they'll say that they are happy with it. I'm always never happy with anything I get, so I would always want more. But realistically, this is a reasonable growth rate for a product of this kind. That said, I think if you look at our premise of where we are short, the plan we had was to say that okay, this will continue to grow at low single digits or single digits, but we will try to go after the IoT business as such, where we will go and do some more end-to-end solutions in the IoT space along the customer lines. On that account, I would admit that we have not been as successful as we would have thought, and that is for various reasons. But I think the fact is that the customers that we work with are pretty much the marquee customers. They are all trying to do IoT, and we were short on our ability to sell to them. And with Mike and some more things that we are likely to do in this quarter, you will see our direct access to customers going up. And I believe that there's also been a change of strategy on how IBM is looking at partners. We are a reseller now. They have decided to hand off, or rather I wouldn't say hand off, but they are trying to focus themselves on larger deals and let partners do more. So that should all help us in increasing the IoT presence.
Okay. Thank you. Very quickly, wage hike impact in 4Q, if any?
Yeah, I mean, some of it's already factored in. There'll be a little bit of wage hike in terms of the senior level people. But also, at the end of the year, a lot of the provisions that were made for bonuses on sales and other teams will get converted to actual numbers. So we'll see where that ends up.
Okay. Thank you.
Thank you. The next question is from the line of Shivam Gupta from CWC Advisors. Please go ahead.
Yeah, I have a question for Sudhir here. So, Sudhir, just to peel this digital growth a little better. So, in the last few quarters, we do understand that given the nature of this work, some deals move from one quarter to another. And at the same time, some deferments take place. So, there should be some interplay of offsetting of this input and output number of deals. And given where your funnel stands, do you think that this 4-5% is something which is comfortable for the next few quarters in terms of QOQ growth for you to do?
Well, I think we set out to grow this business as our growth engine for the company, and I think we're kind of betting a lot on investing in this business. So yes, I mean, we are looking to grow this business. What volume it comes in and what volume it generates from the point of the big bets that we're taking in this business, only time will tell. But some of these things are taking time, and some of these things are a longer term kind of bet for us. It's not short term that we are injecting some money and expecting a result next quarter. So that's what you're seeing right now. That there is a longer sort of horizon for some of these initiatives that we have initiated inside of digital.
So Sudhir, just a small follow-up there. So if I recollect this, you were definitely tracking much higher than where we are, not for this quarter. So is there something in the environment which has changed for the number to come? And when you're saying that these investments are made for long term, is there some kind of time frame you have in mind before you could start tracking any kind of revenue or quantitative milestones on these investments?
Yeah, I mean, look at some stuff that we are doing in the healthcare systems, for example, right? I mean, a large hospital system doesn't move that quickly, and building right now is something that is going to impact their future in a big way, in a pretty significant way, when they engage with patients or when they engage with different physicians, the kind of clinical applications that they have that are riding on the platform that we're building. So these are going to be at least a year and a half long kind of investments that continue. But there are some short-term paths to revenue that we are looking at, which are trying to build those applications even as we put up the platform underlying. So you see some moves there. We've already announced that we built the congestive heart failure application already right now. And the revenue it produces, how much it generates for us right now in the next quarter or two, only time will tell. But I suppose it to say that these are in that kind of a time frame, a year and a half kind of time frame.
So, but when these investments do come to monetize, I mean, even after, let's say, 2.5 years or 1.5 years later, these should be materially higher in terms of the run rate that they will produce currently compared to what we are seeing today in your digital SBU.
No, I think, Shivam, your point is valid.
Yeah.
Let me move on and let me have you this, because we are at the 10 minutes to go on this. I would like to take your question offline, and we are meeting you tomorrow as well. So we'll take this on, but let's keep this moving, Shivam, please.
Sure. Okay. Thank you. Thanks, Anand.
And Sudhir, you can talk to him after this call.
Yeah, sure. Thank you. Before we move to the next question, I'd like to remind our participants to limit their question to one per participant. Thank you. With the next question from the line of Dipesh Mehta from SBI Cap Securities. Please go ahead.
I just want to get update about IP. If I look at the portfolio related thing, if I look investment, what we saw is man kind of thing is flattish for last few quarters. So if you can help us how we are looking, whether there is any change in strategy about IP portfolio and the investment which we intend to make in creation of IPs. And M&A also we have not seen much activity. I think partly you touch upon, but if you can provide overall strategy considering the investment seeing flattish kind of movement over last 8 quarters or so. Second question is any update if you can provide on the partners of USA and Partner Healthcare. Thank you.
Okay, and the first point regarding investment being flat, clearly IP, we need to push the sales rather than the engineering costs. So that is really the plan. And as you are aware, when a lot of the IP was from acquired places that we had taken on, and the whole motivation was to squeeze the costs on it by reducing the efficiency or improving the efficiency by reducing the number of people. So I think squeeze on IP is a good thing rather than be seen as a fact that we are dropping out of IP portfolio. And on the other question regarding, what acquisitions we are looking around for acquisitions, and you'll see some as they go along. I don't know exactly what's happening in the pipeline. That said, I don't want to put a target to the acquisition team to just acquire for the sake of acquiring as well.
Thank you. The next question is on the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
Sir, within our enterprise clients and digital, so what has been the revenue run rate, annual run rate for large clients? What has it reached now?
I don't know what specifically to tell you, but if you look at the top 1, top 5, top 10, you should see an indication of what's happening on them. The other indicators which we are sharing right now are in a fact sheet. We do show you how many customers we have which are larger than 3 million, larger than between 3 and 1. And if you look at them, all of them are trending in the right direction. So definitely our ability to farm or grow an existing account has gone up. And those are all good signs.
Okay. So would we have an enterprise account with, say, 15 million over a 1-2 year period? Or already we are having?
No, we have several, right? Meaning, actually, we have at least, let me say the following, we have at least 5 accounts which are more than 10 million.
Right. Thank you. The next question is from the line of Girish Pai from Nirmal Bang. Please go ahead.
Thanks for the opportunity. Anand, in an interview today on one of the channels, you mentioned about double-digit growth for FY19. Did I hear you right?
Meaning, I think, FY19 is the next one, right? I mean, double digit we should do, right? We should do more than double, right? Meaning, double is still from 10 to 99. I don't know what you are looking for. Clearly, we should do at least double digit, meaning, of course, we'll not be happy if it is only 11. But, yeah, meaning, we should do double digit, but I don't see we're doing triple digit.
Okay. The second question is regarding the IBC CLM deal. 2017, did you break even, or where exactly was the margin for the CLM?
No, we were a little negative. We were more negative in 2016. We were lot less negative in 2017, meaning calendar. And 2018, we will be plus.
Thank you. The next question is from the line of Ashish Chopra from Motilal Oswal Securities Limited. Please go ahead.
Yeah, thanks for the opportunity. Anand, my question once again was around Accelerate. So the 3 to 4 lines of products that you mentioned over here, what I wanted to understand was on the scale of the business from current levels of 32 to 35 million. Do you think that given that this gets sold a lot with other services and packages and hence this grows kind of linearly from this level, or could there be a tipping point to these solutions whereby this can scale significantly in the foreseeable future? Just your thoughts on that. Thanks.
Okay, no, clearly our intention on these products is to see a hockey stick and see a growth rate. Now, unfortunately, because these are all products and the way they need to be sold and all of those things, we can't predict exactly when that will happen, but clearly that is the goal, right? And if that doesn't happen and we're going to see slow linear growth, then we are going to be brutal about shutting them down as well, because, or selling them off or doing something about it. But clearly having a, low linear growth on a product business is a bad idea.
Got it. Thanks a lot.
Thank you. The next question is from the line of Ankit Pandey from Quant Capital. Please go ahead.
Hi, thanks for taking my question. My question to Dr. Deshpande would be, you did mention that, end of life, we've been inactive in the market for a couple of years. So could you just give us a brief overview of the market and where we're looking to participate?
Right. So, actually few things happened in the last few years, which are all trends that came in from different points of view. And when we started this end of life products, we felt that we had a stable growth on our existing business. Unfortunately, the market changed faster than we thought, and by and large, we found that the effort-based business was under a lot of threat. So we did not want to continue on a situation where we are, just growing revenue rather than growing good quality revenue. So that was the main reason why we decided to sort of slow down on some of those and focus a lot more on newer and better revenue.
If I can just interrupt you. So my reading is correct that there is a big overlap between end of life and what you have just said, that you would look to sort of move away from the linear activity or just staffing activity. So if I have to look at inorganic activity for you for Persistent in the IP space, what other spaces will you target more actively to make up for this area where you
so let me finish what I was trying to tell you on this other side. So clearly, if you look at the opportunity side of the business, we think that there is a lot of action in data, IoT, digital areas that we are focusing on. We see a lot of action in machine learning, blockchain, and some of the new technologies that we are working on. Some of these we showcased to people at the Investor Day. We are starting to see action in those. Some of them have reflected into actual deals that have come to us during this quarter, and some are in the pipeline. So we are looking for acquisitions that will help us broadly in a few areas. Let me say the three areas that would be of interest. One is to look at increasing our footprint outside of North America and US, like parks and other things we are looking at where we can go to other regions. Second, to go after IP, which is going to generate us capabilities and strengths in these newer areas like, say, machine learning or, blockchain. Then there is chatbots. There's a whole bunch of things. Again, these will be smaller acquisitions, small team acquisitions, not very large companies, but companies that are helping us in terms of either building out an IP capability or building out a domain capability. So those are sort of where we are trying to go on some of these, and some of them could come out of existing customers selling those pieces to us or whatever. But really, our focus is to go on a trend where we are selling next generation stuff to customers who want to become software-driven businesses.
Great. So if I have to just factor in for next year double-digit growth, would you say that there is a meaningful component of inorganic there?
Without knowing much, I would say yes, right?
Okay.
But I don't know the answer to that question. These things, unfortunately, they have a very weird, it's very unpredictable. But no, we are interested. If you have any products that we can buy, we'll be happy to look at them. I know we are sort of past the time that we want to be now, so I'm going to stop this thing here, hand it back. Finally, I'd like to thank all of you for being on this call. Really appreciate the support. And if you have any questions, by all means, send them to us, and we'd be very happy to answer them for you by email. And tomorrow we are in Mumbai with some of the investors as well, so look forward to meeting at least some of you tomorrow. Thank you very much.
Thank you very much. Ladies and gentlemen, on behalf of Persistent Systems Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.